Welcome to all of you, and thank you for being here with us today. This is actually the first time that the International Monetary Fund presents its midterm outlook on the occasion of the World Economic Forum. And I want to thank Klaus Schwab for hosting us on this occasion. It also gives us the pleasure of seeing all of you, which wouldn't be the case if we were currently in Washington. I will be very happy to introduce in a minute Maurice Obstfeld, who actually needs no introduction. And he and his team will walk us through their findings for the update of the World Economic Outlook. But I want to give you just a few words of introduction, just to give you the landscape as we see it at the moment. Global growth has been accelerating since 2016, and all signs point to a continuous strengthening of that growth this year in 2018 and next year in 2019. So this is very welcome news. And being here and having arrived to the media center in the middle of the snow, we might all think of the words by William Blake, "In the winter, enjoy." But we believe that this would be a mistake, and that complacency is actually one of the risks that we should guard against. We certainly should feel encouraged by the strengthened growth, but we should not feel satisfied. Now, why is that? First of all, there are still too many people who are left out of that recovery and acceleration of growth. In fact, about 1/5 of emerging and developing countries, 1/5 of emerging and developing countries saw their per capita income decline in 2017. Second reason why we should not feel entirely satisfied is that this is clearly a cyclical, mostly a cyclical recovery. And absent continuous reforms, the fundamental forces that had us so much worried about this new mediocre that we feared, in other words, the scars from the crisis, the low productivity, the aging population, and on, and future potential growth, all of that will continue to weigh on medium-term prospects. Third reason why we should not be entirely satisfied: there are uncertainty in the year ahead. The long period of low interest rates has led to a build-up of potentially serious financial sector vulnerability, and we are seeing a troubling increase in debt across many countries, and we need to remain watchful. Now, you will say this is the responsibility of the IMF to constantly see the potential downside risks even down the road, if not in the immediate short term. And yes, it is our responsibility. Doesn't change the fact that we are quite upbeat for the immediate future. But what we're seeing in the more medium term gives us ground for worry. Now, I did say at the October annual meeting that, quoting John Fitzgerald Kennedy, that it's when the sun is shining that you want to repair the roof. I will not venture there today. But it's clearly when the snow stops that here they clear the roads. And the same analogy works. It's a perfect opportunity actually now for the world leaders to repair their roof. And the theme of this year's annual meeting of the World Economic Forum, creating a shared future in a fractured world, clearly demonstrates that. Let me outline 3 areas where I believe that the sharing has a meaning. First of all, shared growth. We think that policymakers should use these very circumstances to make the difficult structural and fiscal reforms that might not happen otherwise, or that were too difficult in times of hardship. And that means taking steps to boost long-term growth, paying down debt in places where it's too high, and in other places investing back into the economy through infrastructure and effective social spending. Now, why is it shared, you will say? because sharing begins by mending your own turf. Second, shared opportunity. We will hear plenty about that in the course of this week. Growth, in our view, needs to be more inclusive, not only across country, which has occurred over the course of the last few decades, but within countries. And some areas of focus, in our view, require training for workers that are displaced or at risk of being displaced by new technologies and globalization. We need those new opportunities for workers at risk. We need new opportunities for young people. And we need new opportunities for women as well, and them being included safely in the workplace. Finally, sharing is about global responsibilities. We need robust international cooperation if we are going to tackle shared problems. And that includes fighting corruption, improving the international trading system, tackling tax evasion, addressing climate change issues, and on and on. So while we should certainly appreciate this season and the good news that we have, we should also certainly focus on the measures that are needed today for long-lasting solutions in order to have that better shared future. With that, I'm very honored to turn the floor over to Maury, who will present to you in details their findings and the update, and I will sit very diligently and listening attentively to what he has to say, and then I'll disappear. Maury, over to you.
Okay, thank you very much, Managing Director. Good afternoon, everyone. The honor is ours to have you introduce this press conference, which is very exceptional, so everyone should know that. This is not how we usually do it. And I'm also going to thank Jerry Rice, who's our Director of Communications, who will be organizing the questions, and Gian Maria Milesi Ferretti, who's Deputy Director of our Research Department. And as it won't come as a surprise that my remarks will echo a number of the things the Managing Director has just said. As the year 2018 begins, the world economy is gathering speed. Our new World Economic Outlook update revises our forecast for the world economy's growth for both 2018 and 2019 to 3.9%. This is true for both years, and for both years this is 0.2 percentage point higher than last October's forecast, and it's also 0.2 percentage point higher than our current estimate of 2017 global growth. This is very good news. But, and the IMF always has a but, political leaders and policymakers must stay mindful that the present economic momentum reflects a confluence of factors that is unlikely to last for long. The global financial crisis may seem firmly behind us, but without prompt action to address structural growth impediments, enhance the inclusiveness of growth, and build policy buffers and resilience, the next downturn will come sooner, and it will be harder to fight. Every government should be asking itself 3 questions today. First, how can we raise economic efficiency and output levels over the long term? Second, how can we support resilience and inclusiveness while reducing the likelihood that the current upswing ends in an abrupt slowdown or even in a new crisis? And third, how can we be sure to have the policy tools we will need to counter the next downturn? Looking first at where we are now, we at the Fund see the world economy as follows. The primary sources of GDP acceleration so far have been in Europe and Asia, with improved performance also in the US, Canada, and some large emerging markets, notably Brazil and Russia, both of which were actually shrinking in 2016, and also in Turkey. Much of the momentum will carry through into the near term. The recent US tax legislation will contribute noticeably to US growth over the next few years, largely because of the temporary, exceptional investment incentives that it offers. These short-term growth boosts will have positive, albeit short-lived output spillovers for U.S. trade partners, but will also likely widen the U.S. current account deficit, strengthen the dollar somewhat, and affect international investment flows. Trade is again growing faster than global output, driven in part by higher global investment, and commodity prices have moved up, benefiting those countries that depend on commodity exports. Even as economies return to full employment, inflation pressures remain contained and nominal wage growth remains subdued. Financial conditions are quite easy, with booming equity markets, low long-term government yields and borrowing costs, compressed corporate borrowing spreads, and attractive borrowing terms for emerging market and developing economies. How do we explain the current upturn? Well, it did not arise by chance. It began to take hold in the middle of 2016, roughly, and owes much to accommodative macroeconomic policies, which supported market sentiment and hastened natural healing processes. Monetary policy has long been and remains accommodative in the largest countries, underpinning the current easy global financial conditions. Even though the U.S. Federal Reserve continues to raise interest rates gradually, it has been cautious, having wisely responded to the turbulence of early 2016 by postponing previously expected rate hikes. The ECB has started to taper its large-scale asset purchases, which have played a critical role in reviving euro area growth, but has also signaled that interest rate increases are a more distant prospect. Moreover, fiscal policy in advanced economies has, on balance, shifted from contractionary to roughly neutral over the past few years, while China has provided considerable fiscal support since its growth slowed in mid-decade, with important positive spillovers to its trade partners. In the U.S., of course, fiscal policy is now poised to take a markedly expansionary turn with complex effects on the world economy. Our view, however, is that the current upturn, while welcome, is unlikely to become a new normal and faces medium-term downside hazards that likely will grow over time. We see several reasons, to some extent reflected in our medium-term growth projections, to doubt the durability of the current momentum. First of all, advanced economies are leading the upswing, but once their output gaps close, they will return to longer-term growth rates that we still expect to be well below pre-crisis rates. While we project advanced economy growth of 2.3% in 2018, our assessment of the group's longer-term potential growth is only about two-thirds as high. Demographic change and lower productivity growth pose obvious challenges, and these call for major investments in people and research. Fuel exporters face especially bleak prospects and must find ways to diversify their economies. A second reason we think this is not a new normal is that the two biggest national economies driving current and near-term future growth are predictably headed for slower growth. China contributes the bulk of global growth, and it will both cut back the fiscal stimulus of the last couple of years and, in line with the stated intentions of its authorities, rein in credit growth to strengthen its overextended financial system. And consistent with these plans, the country's ongoing and necessary rebalancing process implies lower future growth. As for the other big driver of global growth, the United States, whatever output impact its tax cut will have on an economy so close to full employment